Good evening. All right. Happy to be here. Happy to be spending Tuesday night with you guys. Hope I'll be able to share some useful educational information with regards to investment and options for you guys tonight. Okay. And before we begin, as usual, please note the following disclaimer. We are not giving any financial advice. We are merely here doing an educational sharing. All right, so before we begin, let me just do an introduction about myself, okay? Because I think some of you may not know me. So my name is Chris, and I'm Indonesian, but I've been in Singapore since primary school. So I've been in Singapore for a long time. I'm married, and I have two younger sisters. There's a picture of my wedding event. And I'm personally a practitioner of meditation. The type of meditation that I do is called transcendental meditation. It's a non-religious kind of meditation. I do it 20 minutes twice a day. So this meditation style is also used by the Beatles, Tom Hanks, so on and so forth. And it helps me to be more grounded in terms of my investment decision. So right now I'm also into golf, and I also love playing badminton. So I'm also an avid watch fan. So I collect some watches, and I especially love watches that are like stocks, watches that are undervalued. So some brands that are my personal favorite include Grand Seiko, which not many people actually know about, but it offers so much value for its price. Just a quick background about my educational journey. So I went to Singapore Polytechnic, studied business, and I also have a diploma from the University of Washington for international business. And I'm also from SMU. And of course, along the way, I also did some personal learning on my own. Here are some of the places that I've been invited to speak and share. Sidley, NUS, NTU, Money 89.3 FM, and also sometimes I do some podcasts in Spotify as well. This is the NUS Invest feature that I was featured in, and these are just some other places that I've been invited to, Singapore Polytechnic and also internationally. So I just want to share with you guys a little bit more about my background, so at least you guys know who you're talking to, okay? This is my personal blog, so maybe some of you have heard of it or not. You can check it out. It's re-thinkwealth.com. So I usually write in the blog about once a month about investment, about stocks, about my reflections, the Reading Wealth. And I'm also the founder of VIM Mentorship. So for VIM, you can also check it out. And I'll share more at the end of the sharing for any of you guys who are keen to learn more about it. So for VIM, basically, we are here for professional and business owners who are looking to learn and apply and how to get that essential life skill of really knowing how to analyze a company, value a company, and then making decision on their own instead of following stock tips, which is very dangerous. And many people lose a lot of money because they are blindly following stock tips and they are using their hard-earned money, but they make the decision for investment so fast, just like that, right? So instead, in VIM, we want to let the students acquire the skill instead. So in VIM, we have members chat room, a mastermind, and also case study where it's really a high touch course where we really guide and teach them and ensure they apply what they learn. So it's done through one-to-one or small groups 2 to 3. Right. So for this webinar, here are the key 3 things that I like to share and educate. The first one is the limitation of the Black Scholes model. So I think first off, I'll let you guys know that the educational webinar sharing today is a little advanced. And if you guys have not followed our series 1 and series 2 of this webinar, you might not catch some of the things. But do not worry, if you don't catch some of the things, you can get ready the questions and you can use the Q&A tool to ask any questions that you want. So for the next 1 hour, I'm all yours. So here the agenda of this webinar, the limitation of the Black Scholes model, the option strategy that Warren Buffett uses, and some common options trading strategies, such as the bull call or bear put spread. Okay. So the Black Scholes model is a very interesting model developed by 3 economists. Two of them, their name is Myriad Scholes and Robert Merton. They actually received a Nobel Prize in 1997 for their work on this model. The Black Scholes model is also commonly known in the finance world as the option pricing model. And as the name indicates, it is used to price options in order to know the fair price of the call and put options. By the way, at the end of the webinar, I'll also share with you guys a free tool, a free website tool where you guys can go online and use the options pricing calculator so that you can also get the fair price of the call and the put options based on the model that's developed by um these 3 economists. So in calculating the fair price of the option, there are actually 6 variables. There are time to expiry, so how long till the options expire, the underlying stock price at the time, volatility of the underlying stock, type of option, strike price, and risk-free rate. So these 6 variables are all taken into account in the Black Scholes model. For example, if the time to expiry of the options is longer, naturally it'll be more expensive. So all these 6 variables are all taken into account to price the options. And these variables are also known as an options pricing model. So this is how the original formula of the Black Scholes model looks like. You can see it in the screen here. So it takes into account the 6 factors that I just shared with you guys. So we know a little bit about the options pricing model, and in series 1, we already talked extensively about it. So now in series 3 of the webinar, we are sharing the limitations and how we can actually make use of the limitations of the Black Scholes model for our investment consideration, right? When we think about options and stocks, etc. So the first limitation of the Black Scholes model is that the Black Scholes model do not take into account the dividends of stocks when valuing the options. The second limitation is that there's some limitations in valuing long-dated options. Let me elaborate further. So with regards to that the model do not take into account the dividends, here's the thing. I'm sure some of you, if you invest in stocks that pays dividends, you notice that at a certain date, which is known as the ex-dividend date of a company, when the company announced they are giving out X amount of dividend, that day, the stock price naturally dropped. Have you guys noticed that? So when that happens, what usually happens is that on that day, if the company announced they're giving out 20 cents per share in dividends, usually on that day, the stock price will also drop by around 20 cents per share. So dividend does affect the underlying price of a stock. But the model do not take into account the dividends of stocks when valuing options. So that means that in that day when the company announced they are paying dividend, the stock price will drop, right? So how do we overcome this limitation? So because in the model, it assumes no dividends are paid out during the life of the options. So if during the lifetime of the options, if the company pays dividends, technically put options should be worth more because the price dropped, right, when they announce dividend, and call options worth less because it should go up. No, it should go down Yep. So what's the solution for this? The solution for this is that we can adjust it manually by subtracting the present value of upcoming dividends of the stock during the life of the options from the current price of the stock. Then we can input the subtracted value into the option pricing model, which I'll share with you the website at the end of the webinar. So what is the second limitation of the Black Scholes model? So there are some limitation in valuing long-dated options, and this has a link with Warren Buffett. So I'll share on that in a while. Warren Buffett said that when Black Scholes is applied to an extended period, there is absurd results. So he actually mentioned this in one of his annual shareholder letter, which I'll share with you a screenshot in a short while. Here it is. So it says that the Black Scholes model, while it has approached the status of holy read in finance, and people in finance use it, right, to value the equity put options, which is what he does for financial statement purposes. If the formula is applied to extended time periods, it can produce absurd results. And in all fairness, he said that the founder actually knew about this point, but their devoted followers may be ignoring whatever caveats that these two men attached when they first unveiled the formula. Okay, so let me just share some part of this screenshot. Okay, so he gave the example of selling a 100-year-old 1 billion put option on the S&P 500 at a strike price of 903, which was the index level on 31 December 2008. So using the proper option pricing model, he should get a premium of $2.5 million. So, and he sees that the expected loss on the contract will be 5 million. By taking 1 billion, which is the contract value, times a 1% chance that he put that the S&P 500 is going to be worth less, and times it by 50%, which is the chance of that decline. So that's what he did. So using this example, he said that if he received the 2.5 million premium upfront, he only need to invest and get 0.7% annually for the next 100 years to cover the expected losses. So he said this is similar to borrowing money, which is $2.5 million for a rate of 0.7% annually. And he said even at a total loss of $1 billion, the borrowing cost will only be about 6.2%. Okay, so this means that when we use this option pricing model to value a long-term kind of like options, there's actually some stuff that are not as logical based on Warren Buffett. So he has made use of these kinds of market inefficiency to sell put options when the volatility is high, so that he was able to get more premiums and cash flows. And then he used the premium that he received now to invest and get returns. So what is the option strategy that Buffett uses? He makes use of the inefficiencies that he feel Black Scholes model has with long-dated option to sell long-dated put options. So the option strategy that Buffett used is selling long-dated put option. Let me elaborate further, right? Although Warren Buffett said before, for example, in 2 annual letter, he said, in our view, derivatives are financial weapons of mass destruction, carrying has not been very good, right? But he did say that indeed at Berkshire, he sometimes engaged in large-scale derivative transactions in order to facilitate certain investment strategies. So this means that while he acknowledges the risk associated with derivative, such as options, there are situations where derivative can make sense, even for the Oracle of Omaha. So first off, he approaches options as an investment, not a gamble. He don't do like short-term, like 1 week option or 1 month option. He said he believed each contract that he owned was mispriced at inception, sometimes dramatically so. So, of course, using the Black Scholes model, the volatility is implied into the pricing. And he said that the volatility might work for a short time horizon, but the usefulness of the model decreases as time passes by. And his reason is recent stock volatility is not a good predictor of the long run outcome of the stock. So, you know that Warren Buffett have said before that in the short term, the market is like a voting machine, and in the long term, it's like a weighing machine. So, why he said that the model might work for short term, but in the long term, it doesn't work as well because the recent stock volatility is not a good predictor of the long run outcome of the security or stock. So he sells a very long time horizon kind of put options, usually more than 15 years, based on that. The options are European. That means that they're only exercisable at expiry. So he does not have to worry about paying out the notional value before expiry date. And he said it's only the price on the final day that counts. So that's an elegant way to put it. So this is an example of also put options that he sold, right? So this was put options due on 2019 and due on 2028. So these put options is the 37.1 billion and are spread across 4 indices: the US, the UK, the Euro, and the Nikkei. So for the put contracts of 37.1 billion, he received premiums of 4.9 billion, money he have invested. Meanwhile, he have paid nothing since all expiration dates are far in the future. But because based on the law and the financial statement reporting, he reported a mark-to-market loss of $5.1 billion from these contracts, because using the valuation method, it recorded a year-end liability of 10 billion, an amount that will change on every reporting date. So the big question is, can we also sell put option? Although most of us will not have the platform to write a 20-year put options backed by a huge portfolio like Warren Buffett, we can still invest in a relatively long-dated, around 2 years options in the listed market. So like platform in Singapore, like ProsperUs, we are able to do that. So the longest that we can do is around 2 years. So while Warren Buffett have to find another party who are the buyer of his put option, right? For us, we do not have to do that because we have some advantages by selling puts in listed markets. For one, there's more liquidity for us, and usually those options generate much higher premium than the index because of the company-specific volatility and risk, and the volatility again is part of the option pricing. So in the over-the-counter market, like for Warren Buffett, there are counterparty risks. So there are risks that the party may not like pay up, right? But by transacting in the listed options market, there are generally no counterparty risks, and we are transacting with the Options Clearing Corporation, OCC. So OCC is the buyer to every seller and the seller to every buyer in US listed options market. So selling put options can be a useful strategy for investors to get paid while waiting to buy a stock they want to own at a certain price. But as with any investment, there are also risks with selling put options. And again, most of the risks are internal: fear, greed, not understanding the company and its valuation well enough, or by being greedy by selling put options using money that we do not have or stock that we do not want to own at that price. So this is called selling naked options. So in generally, there are 4 types of option trading strategies. The first one is simply selling covered call or puts when we already have the underlying asset, which we cover in a series 2, or buying call and puts, including straddles and strangles, where we can lose the premiums that we pay, but that's the maximum loss. loss, or option spreads, which is buying one or more options and at the same time selling one or more different options of the same underlying, or selling naked options, which has the possibility of unlimited losses. So here are just some of the common trading strategies. Okay, the first one is a long straddle. So in the long straddle trading strategy is when an investor together buy a call and put option of the same asset with the same strike price and expiration date. So they use this strategy when they believe the price of the underlying asset will move significantly either up or down. They don't know it's up or down. So this strategy will allow them to make money if the move either up or down is more than the premium that they pay for buying both the call and put option. So this is long straddle. So it's profitable if the stock makes a large move in one direction or the other, and the move needs to be more than the total premium that the investor paid for this structure. The second is a long strangle. So long strangle is when the first one, they buy the call and put option at the same strike price, at the same expiry, right? But for this, the investors purchase a call and a put option with different strike price, an out of money call option and an out of the money put option simultaneously. So is wider in terms of the range for investors who believe this strategy uh, will allow them to make a profit when they experience a very large movement, but they are also unsure of the direction of the movement. So long straddle is profitable when the price of stock has significant movement in the up or down. It has to move enough to place one option or the other in the money, because for this long straddle, they are actually buying out of the money put or call options, and the movement have to be allow them to make a profit that is more than the total premium that they pay for the structure. Next, bull call spread is that when an investor buy a call at a strike price while also selling a call at a higher price. So both call will have the same expiration date and underlying asset. And this type of strategy is often used when an investor is bullish on the asset, but they want to be able to reduce the premium that they spend on buying the calls. So when they buy the call, they pay the premium, and then they sell the call, they get the premium. So this in a way also will limit their upside to the price that they sell the call option at. Bull spread is a bullish strategy, and a stock price need to increase to make a profit. So the upside here is limited, but the amount spent on premium on buying the calls is reduced by selling the calls at a higher price. Next is the bear put spread. So bear put spread is another form of vertical spread. The investors buy put option at a specific strike price and also sell the same number of put at a lower price. So it's like similar to the bull call spread, but this one they are expecting the price to go down instead, and they use this to reduce the amount of premium they pay in buying the put option. Right. So in summary, the limitation of the Black Scholes model is that it tends not to be as logical in valuing long-dated options, and it does not assume that the company pays dividends. So the option strategy that Warren Buffett uses is selling super long-dated covered put options, and the common options trading strategies that we learned today is a long straddle, strangle, not stranger, and bull call and bear put spread. Okay, so now let me share with you a quick a website where you can actually access the free online calculator for the Black Scholes model. Right. So this is the website. Okay, so as you can see from the website here, they have a few different things, which are essentially the variable of the options pricing model. Okay, let me make quickly. So as you can see, based on this free website, you can input the spot price. So what is spot price? Spot price is basically the current price of the stock. Okay, so let's say the current price of the stock is $10. Okay, and then strike price is basically the price uh, of the options with regards to the put or call options that you have in mind. For example, here, if let's say the current stock price is $10, and then if let's say you are selling a put option with a strike price of let's say $8, and the time to expiry, let's say is months, let's say is 1 month, right? And then the volatility, let's say is 30%. Then the current risk-free rate, let's say is 2%, and the dividend yield, let's say is 0%. You calculate this. Oh, let me see, $9. Oh, yep. So I think $8 is too far off. If you put strike price $9, if you sell a put option for this, you actually, the fair price is that you get 4 cents. So if you actually get 5 cents or 6 cents, that means that there's some mispricing in the options lah, assuming that you have inputted the numbers correctly. So let me illustrate the point. If let's say the time to expiry is longer, let's say it's 1 year, right? The put price becomes 63. So the longer the time to expiry, the more expensive the option is, right? So if let's say it's 1 month is 4 cents, 1 year is 63 cents. Yep, so something like this. So if please ask me some questions, and if you want to ask some questions on this, feel free to do so while I'm here. Yep. Okay, so yep, please please input your question in the Q&A panel. Do not be shy. You can ask any questions about options or even about investment or stocks. And just now I mentioned at the start, can give you some opportunity if you'd like to learn more about value investing and mentorship, where our focus is for students to acquire a life-changing investing skill. So in VIM, we not only teach like options, which is the second part, but we also teach how to analyze a company, how to value them, how to have the right mental models, so on and so forth, in a high-touch structure, one-to-one or in small groups of 2 to 3.
Thanks, Chris. Maybe you just want to give maybe a live example of a demo walkthrough. Maybe you can just share with the audience today, right, on the platform itself, how do they actually navigate towards starting their investment journey on options?
Sorry, Crystal. What do you mean?
Maybe you can do like a live example on the platform itself, like how they can actually start the options trading.
On the platform itself, okay, hold on. Let me log into the platform first.
Sure, no worries.
Yep.
Yeah. While we wait for Chris to prepare the platform walkthrough, so for the audience tonight, right, if you have any questions, be on option strategies, or it can be the platform, or as well as the previous calculator that he mentioned, right, any question you can just input in the Q&A tab, and we'll just address it accordingly.
Okay, let me try to share. Can you guys see the screen?
Yeah, you
Can
can see the
Crystal?
screen. Yeah.
Okay. So this is the ProsperUs platform, right, Crystal? And basically there's build and there's boost. Build is for members with a long-term approach to investing. Boost is more of where you can actually trade the stocks. So this is the ProsperUs platform. Okay, and basically, once you declared your W8 band and everything, which I think I haven't, it's not true yet for me. Then you can just click listed options, and then you can click, for example, I don't know, Disney, right? Then it will show here, right? But yeah, Crystal, I think it will show here, right? For listed options.
Yeah.
Yeah, but yep.
Maybe you can just click anyone as an example to.
Let me see. I Okay, I don't have access to the US market yet.
Sure,
Yep.
no worries. So maybe on trading
Yep.
of options, right? We have actually shared, like previously, the Warren Buffett's in strategies, the option strategies, right? How about yourself? Like, what kind of strategies do you actually utilize when you're actually trading options?
I think for me, when I trade options, I am utilizing a value vesting strategy. So that means that the first step is I have to understand, because behind every option is a stock, right? So option is a contract based on a stock. So for me, the first thing that I need to understand is actually the company first and the stock first. Then I have to have a view of the company's outlook, the company's prospects, the management, and the value of the company with regards to the current price. And that from that view, from that analysis, then I make a decision. Okay, in this scenario, is the strategy better for me to sell a put option because I want to own the stock at a lower price? Or is it better for me to sell a call option because maybe sell a covered call because maybe I already have the stock on hand and I want to sell it at a higher price while waiting to get a premium? Or do I want to buy a long-term call options where I know I have the risk of losing all my money, which is all the premium that I pay, but I exchange that risk with some a potential upside? So the first step is really knowing and understanding about the company and seeing what we are comfortable with. And then from there, we move towards the next step, which is the option strategy.
Thanks, Chris. I think there's a question on selling put. So should selling put should select short duration expiry, right? Or long dated expiry?
For me personally, I like selling put option for companies with high volatility, because from the option pricing model, you know that the higher the volatility, the higher is the more expensive the option is. And when the option is expensive, you want to be a seller, not a buyer. So with regards to buying short-term or long-term option, really depends on the strategy, right? Because for me, I tend to prefer selling covered options because selling a naked options is very, very dangerous. So for me, I prefer selling covered options. And if I sell a covered put options, that means that if I sell a short dated one, which I think I prefer a shorter one, because when you sell an option, sell a covered put, you already have the cash. So if you sell a long one, that means that your cash will sort of be stuck for a long period of time in exchange for the premium. But if you sell maybe like a few days, you will know by the expiry date whether you will use that money to buy the stock or not. So for selling put options, I prefer that. And again, for selling call also, it depends on the environment of the current like market, right? Because if let's say you sell a call at, let's say $10, right, for maybe 3 months, right? Then if in the first month, the stock price actually went to $15, you actually cannot sell it at $15 because you'll be at a loss because you already promised to sell it at $10 for selling like covered call. So in general, when selling like options, covered options, so that means that I already have the stock or I already have the cash. For me, I prefer a shorter one so that I can utilize the market volatility better lah. Hope that answered the question. Yeah.
Thanks, Chris. We have another question on option strategy from Skylar. So from a layman point of view, right, to limit losses and to maximize gains, right? So which buying or selling option strategies can give us limited loss in terms of premiums, I guess that's what he meant, and unlimited upside? Is this the best options strategy?
Okay. Okay, which buying or selling option strategy can give us a limited loss? So if you buy an option, that means you buy call or put options, your loss is limited to the premium. And if you buy a call option, your loss is limited to the premium and the upside is technically unlimited. Is this the best option strategy? I don't think there's any best option strategy. I think if you want to like play it safe, if we follow like Warren Buffett strategy, and the safest is selling put options because that's what he do. He basically sell covered put option. So that means that, hey, I want to buy the stock at a lower price. I already have the cash. In the meanwhile, I get premium and I can use the premium to invest also. So that's the like safest, right? But of course, that doesn't give us unlimited upside because selling like covered put like Buffett is basically like selling premium. On the reverse, should we avoid a naked call or put? Yeah, I think we should avoid because well, we have exposure to huge amount of losses. In my view, we should avoid. Has limited profit. Well, technically, if you buy a naked call, technically it's unlimited loss and unlimited profit. But the danger is, I feel, is so much riskier, right? So you do not want to take that risk. In trading options, should we focus more on risk to reward ratio, or well, I think in trading like options, we should focus more on the company that we understand lah. So I think that's the most important thing. Yeah. Okay.
Thanks, Chris. We have the next question from Eric. Does it mean that it will be better for retailers to buy or sell options for a year? Any recommendations on the options duration?
Yeah. So I think so the question is any recommendation on the option duration. So again, with regards to option duration, it has got to do with our understanding of the company, the portfolio, and also the market at the time. So a short or long duration is can be useful for different kind of company and different kind of views. So I don't think there's any quick answer on whether short or long term is better. But I would say that if you are buying options, for me, I do prefer to buy as long as possible. So like maybe like 2 years, so that there's more time for the thesis to play out.
Okay, the next question is, as a retail investor, how long into the future can we buy, sell the options?
As a retail investor, I think based on the ProsperUs platform and others, I think the longest is 2 years.
Thanks, Chris. So, and actually based on the Black Scholes formula, right, when is the best time to sell or buy options?
Based on the Black Scholes formula, the best time to sell options is when the volatility is very high, so that you are selling it at a high price. And the best time to buy is that when the volatility is very low, so that you're buying it at a low price. But again, the most important thing is the understanding behind the company for the specific options that we are thinking to buy or sell. Yeah.
Thanks, Chris. Just now you mentioned that you always focus on understanding the company or beforehand before you actually trade the options, right? Any particular how do I say, and any particular detail that you will be focusing on, or you actually advise the attendees today to actually focus on the company's particular detail first before they actually trade options?
Because for me, I use options as an investing tool also. So the understanding of the company's quality and valuation is the two key point that I try to have before certain like percentage that I'm looking for. Then I will utilize the options when it makes sense to do so lah.
Will financials of the company be a key that you actually deep dive into before you start trading?
Yes, 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 because it's important to, again, like options, the underlying is stocks. Whether you make money or not from the options depend on the stock movement. So I want to understand how the stock will move, how the business will move before I trade the options.
Thanks, Chris. We have another question from Eugene. After selling a put option, can I close the position before it expires?
Yes, you can close the position before it expires. So if you sell a put option, if let's say the stock price actually goes up, you may be at an unrealized profit already with regards to your put options. If let's say before it expires, the stock price goes down, you may be at an unrealized loss. But either way, you can close it before expiry.
Thanks, Chris. I think that's the last question that we have. So maybe we give some time to the audience if let's say they have any questions. So maybe just want to check with you for currently, right? Are you actually investing in any particular options that you want to share with the audience?
I currently have a long-term position, long-term calls on Carnival Corp. Yep. So that is one of the position that I have. Of course, not a financial advice. Yeah.
Just
So
sharing,
I'm
just sharing.
still quite positive on the turnaround.
Okay, thanks, Chris. I think we have covered most of the questions for tonight. There are no more other questions. So thank you, Chris, for sharing with us your options journey as well as the different strategies that you actually utilize when you're actually trading options. So we hope you have enjoyed tonight's session. So do help us in this little survey that is shown on the screen right now. Thank you, Chris, and thank you everyone for tonight's session.
Thanks, everyone. Happy to be here.
Thank you.